Yeah, look, it's an interesting question at the moment around performance, and primarily because what's actually happened in markets. We've seen such a strong recovery post-COVID, and performance has already happened. And as investors, we all know this, and we've all been guilty of doing this previously, and that's chasing performance. So we saw such a strong month in November this year with the market up circa 10%. And so I'm starting to see a lot of investors coming to me saying, well, how do I chase this performance? And therefore, I'd think about performance going forward, and what I would have investors focus on right now is avoiding drawdowns in their portfolio. You know, as Warren Buffett says, the first rule of investing is don't lose money. The second rule is see the first rule. And I just think right now in the market where we're at, it's a really interesting inflection point. We're back at 6,600 points. We've rallied from some significant lows in COVID. And so I think investors actually need to take stock at the moment, focus on capital preservation to avoid any future drawdowns in the market, and that's ultimately how you compound off a higher portfolio level, and that's how you generate quality performance over time. How are we doing that at the moment with portfolios actually generating performance? Because you can't sit in cash right now because you're going backwards. And so we're thinking where we're targeting capital at the moment, and we're investing clients' capital is in things such as private debt. With the dislocation that equity markets have had recently, we're seeing a lot of opportunities in the private debt space where fund managers and investors can really write their own terms, take security over assets, and still generate very high quality risk-adjusted returns without waking up every morning and worrying about what the stock market did overnight. You can apply this this question about its first mover advantage effectively, being early. If you think about any industry in the world, those companies that had that great idea or that strategy and they were first to market with it, they tend to benefit the most or profit the most from that. And then everybody gets hold of that idea and then they jump in too. I mean, you can think about Afterpay. Everybody talks about Afterpay at the moment. No one was really talking about Afterpay when it was $3, $4 and everybody was talking about it later. So those that saw the opportunity early on and were in Afterpay early really reaped those benefits early on. And guess what? We now have all these other buy now, pay later stocks. So you're seeing that theme in the market. I think that plays very true to the fund management space, where fund managers, when they're starting off, they're particularly the independent ones, where they generally cut their teeth at a larger house that might have that rating from Zenith or Longsec. They're starting off fresh. They have a finite pool of capital. When you have a finite pool of capital, you can be very flexible in how you invest in markets, and that's a very powerful tool. I think funds management is one industry in the world that the larger you get, the more inflexible you become. So you actually lose almost that sort of pricing power in terms of economic returns. Whereas if you stay small and nimble, you can move between asset classes, you can move between market caps, you don't get stuck in stocks, and that's just it's a huge positive for us, and it's a bit of a non-negotiable when we're considering managers early.